Okay, thank you. Firstly, wanted to thank everyone for taking the time to go through the cybersecurity and M&A presentation. I've got you guys for about 40 minutes, I believe. So hopefully we can step through some of the processes and experiences that I've undertaken in my career. Unfortunately, I typically do this talk over a 3-day workshop, so it's going to be a little bit light touch in areas. However, I'm hoping the key takeaways will still be the same. You will get to experience kind of some scenarios and some case studies that I've experienced in my career, and I'm hoping that it will be interesting for you. There aren't many talks on cybersecurity M&A, so hopefully it will be something new for you to think about. Just a quick, who am I? Paul Harrigan. I work at EY. I'm a director. I lead the pre-deal team across EMEA for cybersecurity and due diligence in M&A. I've worked mainly in FS across my career. I've also spent some time at Accenture. I consider myself a security architect, a blue teamer very much, and in my spare time I like to do things like bug bounty and play CTFs. You can catch me at the Freud if you have any questions or fancy connecting. Right, so the first thing I wanted to just go over is what is mergers and acquisitions, and what does it mean? Because it can mean a lot of things to a lot of different people. So for me, when I talk about mergers and acquisitions, I talk about an event across the capital agenda. So that can be an investment, a corporate merger, an integration where two companies come together, a separation where a big company split apart and maybe one side gets sold, a carve out. Carve out is where a portion of the business is sold, so they literally take a small part of the business and sell it to another entity. A divestment, where maybe a part of the business isn't doing so well, and it's agreed that it's no longer needed, so they close that part of the business and divest it. And the last scenario is a JV, a joint venture, so where multiple parties get together and invest or cling together. Capital venture private equity firms club together and invest in a certain company. So there are a lot of different types of scenarios that cybersecurity can touch when it comes to mergers and acquisitions. But for this talk today, I wanted to just touch on one of these scenarios, and that's investment. So we're going to be looking at a scenario where we're going to be thinking about private equity companies. And so a private equity company may invest into a business, may invest up to a percentage stake. Maybe it's a 51% stake, therefore they have a controlling stake in the business, or maybe it's only a 20% stake, therefore they're just kind of on the board and they have an avid interest in their investment. Okay, so when we talk about mergers and acquisition today, I want to think about investing. Okay, so not corporate mergers or integrations, but just an investment. So the company stays the same, but just an investment. Okay, so the biggest case study that I can think of where cybersecurity actually had a real impact was the Marriott buyout of Starwood. This happened back in 2016. Marriott Hotels decided, in order to grow its geographical footprint and just basically wanted to take over kind of all of Starwood's hotels, they decided to make an acquisition for $13.3 billion in 2016. So huge investment. Two big names, two big companies coming together to really dominate the hotel market across the globe. Now, this was all well and good. However, in 2016, a few things happened. Okay, actually, historically, without Marriott's knowing, back in 2014, Starwood had a breach. A malicious actor was able to gain access to Starwood's loyalty program and was able to leak out kind of a lot of information regarding personal identifiable information, kind of email addresses, passports, names, date of births, credit card numbers. So a lot of information was leaked and held onto by these adversaries. So unbeware to the Marriott when they actually purchased Starwood, in 2016, it was discovered after the acquisition had taken place that this breach had, this breach had happened. So actually, because Marriott had bought them, they were actually accountable for what happened 2 years ago, before they even had an idea about Starwood. So really, really interesting case, this one, because they literally had no idea, they had no control over it. What was interesting was that Marriott stocks instantly dropped by 5%. So you can imagine all of the shareholders weren't too pleased about learning this information. And 2 lawsuits seeking class action status, one for $12.5 billion, were filed. And the US Senate started to discuss stiffer fines and regulations based on this. So already a huge impact was had on this. Moving forward to 2018, in the UK, the ICO said that about 30 million of the hacked guest accounts related to 31 countries in the European kind of area, and 7 million of those leaked records were related to UK residents. Therefore, the ICO is proposing a £99.2 million fine for Marriott. I mean, that's an awful lot of money and an awful lot of bad reputation to take on board. One thing that was clear, the ICO said that the Marriott failed to undertake sufficient due diligence when it acquired Starwood, and should have had more, a better process in place to understand historic cybersecurity and information security incidents when they came to acquire the business. I mean, it was evident that they didn't actually do anything, and therefore they took on board all of these fines. So that there is a huge case study for actually why cybersecurity due diligence, when you come to acquire a business, is very, very important. And that case study there is the foundation of what this talks about. So when we go through the rest of this talk, I just want to go through a quick scenario. So whenever we reference certain things throughout the deal flow, which we're going to get to, I want you to think about the scenario, right? So there's a mid-market private equity firm, okay, and they're looking to invest $100 million for a 51% stake of an Italian renewable energy provider that specializes in solar technology. Okay, that sounds decent. The thesis for the investor is to expand its geographical footprint. Okay, so it wants to expand its footprint into EMEA and open a B2C business marketplace. So currently it operates in B2B. It's going to operate in a B2C marketplace across EMEA, not just in Italy. So okay, that makes complete sense. Their investment hypothesis is to hold the asset for 5 years and then sell at a large margin, either via IPO or via private sale. But they want to take their 100 million and sell it for kind of multiple stakes higher than that. Okay, so maybe into the 200-300 millions. Okay, so across that next 5 years, the investment life cycle has to be put under stringent measures in cybersecurity and information security defense. Okay, so that's the scenario we're going to be thinking about when we go through the rest of this presentation. But just to quickly reflect, what do private equity investors really care about? Well, they care about their investment. They don't really care about cybersecurity. They don't really care about breaches. They care about their money. And I think that's fundamental in understanding when dealing with private equity clients. Their money is paramount, and how they can actually get a return after their hold period. So this 3-part, are they getting a good deal? And that's what we need to decide before they buy the asset or before they invest in the asset. How do they ensure that the value that they've invested doesn't erode through that 5-year period? And that's like the hold phase, so the time that they actually have their stake within the business. And how do they evidence that they're selling in good cyber hygiene? How do they get that maximum value back? So they're the 3 key phases and the 3 key themes that investors really care about when it comes to cybersecurity and deal flow, right? So are they getting a good deal? How do they protect their money, and how do they sell at a profit? Okay, that's fundamentally what they care about. And to put that into a view, to put that into a graphic, this is a chart here that shows kind of an investment life cycle. Okay, so you'll see here you've got the equity investment. This is year 1. Okay, so they've invested in at 60 million here. And this is where we are today. So we're 1.5 years into our investment, say, and actually because we've shown, you know, growth and geographical presence, and we're making more sales, more revenue coming into the business, the value of the business is actually gone up 10 million. Okay, so, and actually based on forecasts, we actually see that the equity value could rise all the way up to 90 million after 5 years, and that's where you want to sell. Okay, but what could actually change this graphic? What could change the forecast? Well, if we think back to the Marriott's incident, you know, Marriott's viewpoint, a historic incident could really erode the value. As you saw, the 5% loss in shares or the fines that came out could really push down the value. Okay, so understanding what happened in the past is very, very important. Also, understanding what could happen in the future. Obviously, you're injecting a lot of capital, you're injecting a lot of investment into this business, and you're going to be changing the way the business operates. Okay, you're going to be enhancing certain features, certain services. You're going to be widening the threat landscape considerably. I mean, we said we were going into new geographical regions. We said we were going to start selling B2C. So obviously the threat landscape has widened considerably. So future security incidents needs to be thought of. We need to threat model against what could potentially be coming to avoid that value erosion. And also, we've got to ensure that we continually fix risks. We've got to mitigate risks and remediate to get back to a compliant position, because there is a cost to these fixes. You know, penalties, brand reputation, everything that can happen in incidents can really damage that bottom line costs and bottom line figure. So we've got to really fix against compliance, against regulations also. But how do we add value? How does cybersecurity really push up that value? Well, if you can evidence tactical implementations, good cyber hygiene, strategic knowledge of what's happening in the market, you can actually suggest that you've protected value. Okay, and that will maintain the journey forecast up to that enterprise value when you come to sell, avoiding the potential losses over the chip. Okay, so as a visual, I hope that kind of gives you kind of an investor's view on what could damage the sell value when it comes to cyber incidents. Okay, so this next slide talks about deal flow, and what you can see here is the investment life cycle. It's in a very simplistic form. Okay, so the deal life cycle happens in 5 stages across 2 kind of different sections. So you've got pre-deal, so the M&A strategy, target selection and diligence happens kind of before you make your investment, and then the area where we spoke about asset hold and exit readiness when you come to sell happens post-deal. So that's, you know, that happens after you've actually made the acquisition or the investment. Okay, so we're going to talk about these sections and where cybersecurity comes into play. Okay. So the first stage is M&A strategy. Now, as an advisor to private equity in cybersecurity, I often go and speak to private equity advisors and inquire about their funnel and inquire about what they're planning on investing in that quarter or in that half year. And typically they come back to me and they say, okay, we want to think about assets in an industry, for an example, the energy industry, or, you know, based on this example, and we're thinking about asset 1, 2, and 3. Okay, so we've got 3 different businesses they're thinking about, and they're looking at the market value and taking into account kind of how they forecast the values of this business. And what, from a cybersecurity perspective, it's my job to actually go back to them and suggest, okay, looking at this business, what can I learn? What can I tell my client about the cybersecurity risk, and, you know, based on this high level view? Well, I can tell them quite a lot, really. I can tell them about kind of the industry risks. I can tell them about the geographical, you know, maybe some geopolitical incidents that may be going on in the world today. I can tell them about kind of new threats hitting the industry, and maybe they're looking to get into a new e-commerce platform, you know, a certain type of platform, and I can advise them on, okay, actually what we've seen in the industry in recent weeks is these commerce platforms are being targeted, so maybe it wouldn't be such a good investment. So we can really kind of give a high level overview. We can also understand about the businesses themselves and how their key executives react to social media marketing. You know, how their businesses react to brand reputation, social, you know, all the social media aspects. You know, are they really reactive and sensitive to bad press? So there's really is an interesting viewpoint at the M&A and strategy point of view that you can hand over from a cybersecurity perspective to your client. But once they actually come to you and they say, okay, we're actually thinking of moving to invest into this Italian business. Okay, so they're looking to invest into this Italian business for 100 million. Then I can go, okay, right now I know who you're talking about. I can go away and do some real reconnaissance on this business. So at this stage, you're still not allowed to talk to the business, but what can I actually gain from an open source threat intelligence kind of viewpoint to feed back to the client? So from a reconnaissance perspective, I can understand the jurisdiction to where the target operates. You know, are they in Europe? How do they react to GDPR? You know, what kind of data do they collect? How do they process it? Are there third parties involved in their supply chain? You know, there are a lot of kind of open questions that can be answered from the outside. Are they facing any geopolitical issues? I once represented a client that wanted to invest into an oil pipeline in the Middle East, and at the time, Lebanon and well, I won't go into it, but at the time there were two countries facing political standoff, so it wasn't a good time to invest. And from a security standpoint, the local governments were controlling what data was captured and what data wasn't. So it was really good advice that I was being able to pass on to the client. We can also learn about kind of evidence of past security incidents that are known to the public. Kind of if someone were investing in the Marriott now, we would know kind of what happened in the past and how they reacted to it. You know, what was stolen, what was targeted, etc., etc. So you can learn an awful lot. And I go back to social media sensitivity. I mean, you can learn a lot about the C-suite online. You can learn a lot about how different board members are presented. You can go onto deep and dark and social web platforms to learn an awful lot about kind of how open these key executives are and how sensitive they are to brand damage. So this is a really good kind of way to feed back information to the client without actually having spoken about anything to the business. But if the client says, okay, we take on board all of the potential risks that you put forward, we actually accept those risks and we're going to work through those risks, we actually want to make this exclusive and we're going to get into a diligence phase. So the due diligence phase is broken down into 3 parts. Okay, historic is the first part. This is where you can actually get information out of the business. You can contact the business and you can do a lot more. Investigative work. Okay, so from a historic perspective, as we learned from Marriott, you definitely need to look into the incidents that have happened in the past 24 months and how they've handled those incidents and kind of how they've grown, what lessons learned have taken place, etc., etc. You need to understand if any rapid technology growth has taken place, because often that's where security is overlooked and not, you know, retrospectively fit and not fit up front. So definitely looking at the strategy and the growth of the business. You need to identify the frequency of reviews. Now, do they actually perform external audits? Do they do offensive, defensive tests? Do they have evidence that they've actually proactively and reactively reviewed their own business with an independent standard? Right, so that they're very, very key points to understand from a historic perspective, and then build a case for what they've and how they've grown in the last 20. The second part is around the present day. Okay, so obviously this is where you can pull in an industry kind of an industry-wide and respected framework, whatever the framework of your choosing is. But this is where you need to understand the current business operating model. It's very, very important. You need to understand the current risk exposure against a leading framework, and you need to kind of identify the gaps and the risks against that framework. So gaining a posture state of where the business is right now. You need to understand what they control. Okay, do they understand what they control? That's always a key question. You know, how they classify their data, how they understand what data they control and how it flows in and out of the business. You need to review the regulations that they currently sit within. Okay, you need to understand how they manage those regulations, how they comply with them. Do they get sign-off? Are they in a good position to react to responding to a breach and understanding, you know, if we're in the UK, how to respond to the ICO? You know, all of those kind of models need to be in place. You need to review significant contracts that they have with third parties. Often these are overlooked, and the third parties are the weak point in the chain, and data's leaked out the third party. So we've seen this in several recent breaches. You need to understand the external exposure, so kind of the outside in perspective of the business, kind of how they operate, you know, what internet facing portals they may have, you know, do they look after them, do they test them, what, you know, what is shared, etc., etc., you know, how access is permissioned, and understand their defense capabilities. Understand, is the tooling fit? Do they have the right human capital position? Is there a skills shortage in this business? All of these questions need to be thought of, because not only do you need to be able to identify the risk, you also need to be able to identify the cost it's going to take to get themselves to a decent posture state, because that cost, once this investment is made, goes back to the investor. Okay, and it becomes their problem. So actually what you want to be doing is advising your investor, okay, there's a shortfall of 2 million, maybe in human capital, maybe in tooling, maybe in policies, etc., projects. That needs to come off the price, or that needs to be fixed within the first 6 months, etc., etc., right? So they need to be made aware, the client needs to be made aware of any kind of financial burden that they may be undertaking. But not only do you need to look at the present, you also need to look at the future. Obviously, as we said before, you're injecting a lot of capital into this business. It's going to change the way the business operates. And what does that mean for the business? You need to understand what the strategy is. An investor will be coming in with a deal thesis, and they'll want to be growing that bottom line. They'll want to be growing the amount the business generates in revenue. So what does that future strategy mean? But think of it like this. Don't think of it, because our scenario here is a 5-year plan, we don't really care about a 10-year plan, right? We care about a 5-year plan. We care about a 1, 2, 3, 4, 5-year plan, because after 5 years, the investor's getting their money out and they're our client. So that's what we care about. So we actually want to assess the future risk around that 5 years and what we're going to be introducing in those 5 years. Okay, if technology is rapidly evolving and transforming or rationalizing or expanding in some way, we want to know how we're going to secure within 5 years. New threat landscape, we want to know how much it's going to cost. So we need to know at this position, before we actually invest in this business, what that's going to cost to do. If we're going to be growing into EMEA, maybe we're going to be trading solar panels in Africa, what does that mean? You know, currently we only do it in Italy. Well, obviously there's going to be a lot more expansion, there's going to be a lot more growth, new operating model, new tooling to protect that new operating model. Okay, new human capital as well. So that always comes down to a figure, and that's what investors really care about. All that said and done, if you present that and the position is good, and the investors say, okay, let's go with this, and they get into the asset hold part of the business, they've made their investment. Now you're on that 5-year journey. You're now on the other side of the fence, where you're part of the business, and you've become a strategic advisor for the CISO and the C-suite of this business. So your position is different, but you still need to advise on the strategic roadmap linked to the investment thesis, because that's still very, very important, based on typically a 100-day plan, and all of the risks that you've identified in the due diligence phase need to be mitigated within this roadmap. Okay, and you need to proactively plan for new attack vectors that are introduced by that injected capital. Okay, so you're actually in the risk remediation program now, and you're advising and you're helping the in-house security teams manage their security risk. So you're back to that diagram we saw before, where you want to avoid those future breaches that will erode value, but we want to kind of maintain the brand. We want to protect the brand, protect the corporate IP, and ensure that when it comes to exit, everything's in place, security hygiene still in place at a really strong level. Okay, and then finally, when it comes to sell, okay, you're going to be coming up against other investors maybe that bring their own cybersecurity due diligence team. So they're going to be asking all of the same kind of points of question that we asked at the pre-deal stage of this. So you want to ensure that the business is best positioned for exit. So you want to ensure that all of the potential questions that you would ask in your assessments can be answered, and you want to ensure that you're evidencing your business in its greatest light. Okay, so if you have unfortunately had a security breach, you want to explain how you handled the breach. You want to explain how root cause was solved, how you handled the regulators, how you handled the clients, how you handled everything well. And you want to put forward a position of confidence within the business. Okay, if you're lucky and you haven't had any kind of breaches, you want to still evidence that you were aware of them, you were monitoring all the time, you were, you know, these are the logs, these are the reports that we were discussing on a monthly basis that show how we mitigated risks, and we were threat hunting, and we protected, and we put across the best measures to ensure that the business was in a great posture state. And you want to be ready to alleviate and combat any issues that come out of the buy-side security due diligence, right? So they will ask the same kind of probing questions that you asked. So ensuring that you've got everything in hand enables your client and your investor to get back their money with as much investment as possible. Okay, so we've quickly gone through deal life cycle, and we've gone through the scenario, okay, and we've gone through how we approach cybersecurity and M&A through a deal lens, okay, and from an investor's point of view. So the key takeaways from this talk kind of is to understand the key point here is to understand the deal thesis. This is what drives the risk acceptance criteria of your client. They may not care about certain things, they care about their money, but you need to know what their injected capital is going to do, what it's going to evolve, how it's going to evolve the business. Are they going to need to enter new markets in order to grow the investment? And what does that mean from a future threat landscape? And how can you put in place how do you identify that risk? How do you threat model the future for the PE firm? And that understanding that deal thesis is very important. It differs greatly to just a standard cybersecurity assessment, which gives you kind of the posture state of where they are now. The next point is around the investment itself and what it will introduce. Okay, so as I just said, it widens the threat landscape, and you need to be aware of how you're going to combat those risks in the future and what it's going to cost. And kind of the last point is around the short and medium term strategic journey, right? As I said, the investment only in this scenario is only 5 years. So the key, the key is here not to actually have any real security impact from a breach perspective or an incident that causes brand damage or service to your clients or to your customers in that short and medium term journey. You've got to identify the possible synergies to reduce spending. This is the key one, because in every business, sometimes in order to make money, you have to reduce kind of key tooling, or you have to reduce the expenditure that the company undergoes, and it's key to identify the key synergies between tooling or potential other assets within the private equity portfolio that could help the new investment. So for an example, you could be investing into a business which you've also invested into its competitor. So actually you've got two businesses in the same industry that could share resources. They could potentially share a SOC, for example. They could potentially share kind of threat intelligence, etc., etc. So you could reduce the costs of expenditure. Human capital is a key one as well. You could have multiple people doing multiple tasks across multiple businesses, kind of virtualized functions, etc., etc. So there are lots of ways to reduce expenditure. And the main thing that you need to do is identify risks that may affect, may affect the deal. That's exactly what we're here to do. We're here to identify to the client, to the private equity firm, okay, these are the key risks. Do you want to invest in this company knowing about these risks? Are they fixable? If they are fixable, well, then we'll put it into the term sheets that they have to fix it within the first 6 months, and that will hopefully reduce the risk matrix and the risk complexity that we've identified. And lastly, we need to mitigate those risks as we go through the whole period, and definitely hit those ones that require immediate attention, okay, and that they need significant investment to remediate. That's important because that's where cost comes into it, and that's where we've got to really identify upfront what needs to be done and how much it's going to cost the investor. So at the diligence stage, those cost to achieve points are really, really key. All right, I hope I kept that in time, probably about 35 minutes. I'm happy to take any questions you may have. Sorry, it was a bit whirlwind and a bit fast, but please, I'm open to any questions you may have. Thank you.